Hi, welcome to this presentation where I'm going to give a quick overview of budgets in general, and more specifically I'm going to look at simple cash budgets. Cash budgets are far and away the most common examination question at A-level. There are a number of other budgets which most A-level students will need, some specific to what I'm teaching at the moment, which is Edexcel, but most of them are pretty common across all the A-level subjects. What is a budget? The key point with the budget really is it's done at the start of the year. So it's not something, if you look at normal final accounts, they're done after the year has ended. They are looking back and they are using factual information. What a budget is using is, if you like, a best guess of what the future is going to hold for a company. And it shows this predominantly in financial terms, although some of the budgets either are or can be given, for example, in terms of units. And ordinarily, if you work in a business, you would also split that budget. So you do a budget for the whole year and you would split that down into months. And it's quite important to look at it in terms of months if you've got seasonality. So what we mean by seasonality, for example, in the UK, if you are a toy shop, by far and away the majority of your sales are going to occur in November and December when parents are buying presents for their children. Why do we do budgets? Why does a business need to try and predict the future? Well, it needs to plan. So, for example, cash is very important to all businesses. You need to plan whether you're going to have enough cash. You need to plan as to whether you are going to need an overdraft from the bank. If you're looking at production budget, you need to see if you have the capacity to produce what we expect to sell. And if not, you need to do something about it. Businesses then monitor the budget and they are checking on a monthly basis that their results are in line with the budget. If, for example, sales are well ahead of where we expected them to be at the start of the year, does that mean we need to then go and revisit what we are producing? Controlling, that means making adjustments to meet targets during the year. So, for example, if we do realise that our sales have been under forecast, do we need to make changes throughout the business to meet what essentially is good news? And similarly, if sales had fallen, then companies do need to plan to reduce what they are producing, to reduce what they are buying. It is a decision-making tool. So as part of the budgeting process, the firm is having to make decisions. It's having to make decisions about, does it need to increase capacity? Does it need to reduce capacity? And something that's sometimes overlooked, but budgets are also a coordination tool. We work through a series of videos on budgeting. What you will see is that all the budgets are interlinked. If we've got a sales budget, it links to information that then goes into a production budget. If we've got a production budget, we need to buy the raw materials to make those products, and therefore it gets linked to a purchases budget. If we are purchasing things, then we need to have money available, so that needs to link to a cash budget. Quick mnemonic that one of my students thought of about 6 years ago. This young lady came up with please make cream donut cakes as a way to remember planning, monitoring, controlling, decision making, and coordination. I always used to use Manchester City play Derby County, but that's probably a little bit specific, really, in terms of I enjoy football. So please make cream donut cakes actually works very well, I think. Okay, cash budgets, what do they look like? You will see on mark schemes slightly different versions, but there are some basics that you've definitely got to have into your cash budget. You've got to have receipts. Receipts are cash physically coming into a business, and for this business they've got some sales and they also rent something out. Okay, and then there'll always be a total of all of the receipts of the business. Now clearly you wouldn't need to do that if this business only had sales, because the sales are the receipts. And then there would be a section for the payments. In this business, I'm just doing a simple example. So we've just got 2 payments going out of the business and a total. And then at the bottom, we've got a summary of the overall cash position of the business. Okay, so the opening balance is the amount of money that they have at the start of the time period. In this case, it's 10,000. We add all the receipts in the month, 110,000. We subtract all of the total payments, in this case 48,000, and that gives us a closing balance of 72,000. So at the end of month 1, this business was expecting to have 72,000 in cash. And then basically you just carry on using the closing balance from the first month to become the opening balance for the second month, and then the formulas just work all the way through. And something you can see from this is that this is something that's very, very easy to do on a spreadsheet. You just need some very basic formulas in there, and then you can drag those formulas across, and that makes the budgeting process a lot easier. And most of the early use of spreadsheets when they first came out was for things like budgeting. It made the whole budgeting process an awful lot easier. Okay, so quick example of a question. AJ Hardware, they expect to have an opening cash balance of 5,000. That obviously goes in as the opening balance down here on the summary of the cash position during the month. We've then got the sales, and we're going to assume in this case that all the sales are in the month, the cash is received in the month of sale. What you will find when you come to do examination questions is that that cash may be split over a number of months, so it makes it more complicated. So we put our sales in. Okay, I've put a total row in for the total of all the receipts, but as I've said, that wouldn't necessarily be required if you've only got one receipt. Okay, the purchase is paid for in the month following purchase. So just the one thing we need to be careful of here, okay, the December purchases are going to be paid in January. The January purchases will be paid for in February. And the February purchases will be paid for in March. And we don't need to do anything with the £23,000 of March purchases, because they will be paid for in April, and it's outside the period that we are doing the budget for. Staff wages are paid in the month, so that's straightforward. We can just add the 3 figures in that correspond with the month when the work was done by the members of staff. And the rent is paid quarterly in the second month of each quarter. So because the financial year for this business runs between January and December, a quarter of the year is 3 months. Be very careful. It's quite common when I've been an examiner to see people putting in quarterly figures every 4 months. It's every 3 months, and it's paid in the second month of the quarter. So the quarter that goes January to March, second month is February. And we need to do a quick calculation here to find out the amount of the rent. It's a very simple calculation. We just need to do 6,000 for the annual rent divided by 12 times it by 3, and that gives us 1,500 in terms of rent that gets paid in February. We then total up all of the payments, and we then add total receipts and total payments for the first month, which is January. Do our calculation. Remember this calculation, it's important. Opening balance plus total receipts take total payments. Gives me a closing balance of 20,000. I move my closing balance from January to be my opening balance in February. And then I just work through and complete the formulas. So at the end of March, this business is expecting to have 48,500 in cash. Right, obviously this is a very, very simple question. They can be far more complex at A level. The basics are all the same, okay, but it's a matter of working through and getting some practice. For my students, and then there's a little bit of theory at the end, and there are a couple of very simple budgets for you to do. Obviously, the good or bad news is you will be doing quite a large number of these, and we'll work up to do some quite complex ones, although they just use the basic theory that we've gone over in this video. Okay, so if you're one of my students, if you want to pause the video now and just do the questions, and then come back and just do the last part of the theory, that would be great. Okay, something that some students get confused with, they kind of look at this summary of what happens in the month or over a whole year, and quite a common exam question then is to ask them how it's different to the profit figures for the business. And there's just a number of key points that you would need to bring out if you're looking at the difference between a cash budget and an income statement. Over and above the fact, of course, obviously, a cash budget is done at the start of the year. An income statement would be done at the end of the financial year. Here the business has a total inflow of £15,000, and we calculated that total inflow because we looked at the difference between the receipts and the payments, but you could also look at the difference between the opening and closing balance. And it's an inflow because the closing balance is 15,000 more than they started the period we're looking at with. This doesn't mean that the business has made a 15,000 profit. And the three big reasons behind that are, first of all, our cash budget only looks at our projected cash inflows and outflows. It doesn't consider those non-cash expenses that we've already covered in the courses that I've taught, things like depreciation. Okay, that depreciation links to a cash outflow, but that cash outflow was when we purchased the assets, and that would have been in previous years' cash budgets, and the expense of the depreciation would appear spread over a number of time periods. So non-cash expenses generally make the profit figure lower than the cash flow. A cash budget would include all of the cash inflows and cash outflows linked to capital expenditure and capital revenues. So, for example, we may have a cash inflow from selling a vehicle that a business owns. Okay, that cash inflow of selling a vehicle isn't a revenue in the income statement. Similarly, if we were to purchase a new vehicle, that would be a cash outflow and reduce the amount of cash available in the business, but only the depreciation element of that vehicle will appear in the income statement. So if we purchased a vehicle, we would have a larger outflow than if we didn't. However, the impact on the income statement as an expense would only be marginal due to depreciation. And we've also got the other big difference are timing differences. So, for example, if a business was to sell some goods on credit at the end of the financial period, that would be considered to be part of the revenue of the business. It would not be included in the receipts of the business because the cash has yet to change hands. Right. Hopefully, you followed everything that we've gone through. Obviously, my students do the examples. There'll be some homework questions on this, and we'll do some more work on it in class. Okay, but good luck if you're one of my students. Obviously, email me if there's something you're unclear about. Thank you very much, and have a great day.